Hey everyone, and welcome back to Mita Money. I'm Mita, and today we're tackling a massive shift in the crypto world that is set to redefine one of its cornerstones in 2025, stablecoins. Imagine for a second, what if the very foundation of how you use stablecoins, their safety, their reliability, even the value you place your trust in, was about to change? Well, it is. Today we're diving deep into the Genius Act. We'll break down what it is, how it's going to shake up the stablecoin market, and most importantly, what this all means for you as a crypto investor. This is a big one, so let's get right into it. So, first things first, what exactly is the Genius Act? It's not just a clever name. Passed by the U.S. Senate in mid-2025, Genius stands for the General Innovation and U.S. Stablecoins Act. Think of it as the first major rulebook for stablecoins in the United States. Before this, the stablecoin landscape was a bit like the Wild West. Lots of potential, but very few sheriffs in town. Regulation was fuzzy at best, leaving a lot of gray areas for issuers and users. The Genius Act changes all of that by introducing a clear regulatory framework. Let's look at the key pillars of this new law. First, and this is huge, it mandates that all regulated stablecoins must be backed one-to-one by highly reliable liquid assets. We're talking about assets like actual US dollars held in a bank or short-term US Treasury bills. This is designed to eliminate the guesswork and ensure that for every digital dollar you hold, there's a real, verifiable dollar sitting in a reserve somewhere. No more backing by mysterious commercial paper or other more volatile assets. The second key part is transparency. The Act requires regular, mandatory audits of these reserves by independent, qualified firms. Issuers can't just say they're backed. They have to prove it, and they have to prove it often. These audit reports must be made public, so anyone, you, me, regulators, can look under the hood and see for themselves that the reserves are solid. This transparency is a game changer for building real, sustainable trust in the ecosystem. Finally, the Genius Act establishes a dual oversight system. This means both federal and state regulators will have a hand in overseeing stablecoin issuers. This two-layered approach aims to create a robust system of checks and balances, preventing any single entity from having too much power and ensuring that consumer protection is a top priority, no matter where an issuer is based in the U.S. This is a monumental step away from the vague, patchwork regulation we've seen in the past. It's about bringing stablecoins into the mainstream financial system with clear rules of the road. Now you might be wondering, why the big push for regulation now? Why are lawmakers so focused on stablecoins? The answer is simple. Stablecoins have become too big to ignore. They are the bedrock of the modern crypto economy. They were used for everything, from trading on exchanges and executing lightning-fast cross-border transfers to powering the entire world of decentralized finance, or DeFi. Their total market cap has exploded, rivaling that of some traditional financial institutions. With this massive growth comes massive risk, especially when the backing of these stablecoins isn't clear or transparent. We've all heard the horror stories. Remember the panic during major depeg events, where a stablecoin suddenly loses its one-to-one value with the dollar? Or the fear of a run on the stablecoin, similar to a classic bank run, where everyone tries to cash out at once, causing the entire system to collapse. These aren't just theoretical risks. They've happened, wiping out billions of dollars in investor funds. Regulators have also been very concerned about the potential for fraud and market manipulation. Without clear rules on reserves and operations, bad actors can exploit the system, making promises they can't keep. Lawmakers see these vulnerabilities not just as a threat to individual crypto investors, but as a potential risk to the stability of the broader financial system. Their goal with the Genius Act isn't to crush innovation. It's to protect consumers, prevent financial crises, and create a safer, more predictable market where legitimate projects can thrive. It's about making sure the engine of crypto, stablecoins, is running on clean fuel. Okay, let's get to the most important part. How does all of this actually impact you? If you're a crypto user, whether you're a day trader, a long-term holder, or a DeFi enthusiast, These changes will affect how you interact with stablecoins. First, if you currently hold stablecoins, it's time to do a little homework. The Genius Act will essentially create two tiers of stablecoins, the regulated and the unregulated. You'll want to start looking for stablecoins that are actively seeking compliance and have publicly audited reserves. Your favorite stablecoin, the one you've been using for years, might be subject to much stricter rules. This could mean changes in how it's managed, its underlying assets, or even its branding as it shifts to become compliant. On the flip side, some stablecoins might struggle to meet these new, stringent requirements. A project that was a bit loose with its reserve management, or operated with a lack of transparency, might find it impossible or too expensive to comply. This could lead to a few different outcomes. They might have to completely overhaul their business model, which could affect things like transaction fees or the interest you can earn on them. In a worst-case scenario, some could become illiquid or even cease operations in the U.S. market, forcing you to find an alternative. The trust you placed in a particular stablecoin could be tested. So let's weigh the pros and cons. What are the benefits versus the risks of this new regulatory era ushered in by the Genius Act? On the benefit side, the biggest win is stability and confidence. With one-to-one backing and regular audits, the risk of a major stablecoin depegging and collapsing becomes significantly lower. You can have much more confidence that your one digital dollar will actually be worth $1 when you need it. This reduces the chance of nasty surprises and makes the whole crypto market feel a lot safer, which could attract more institutional investment and everyday users. However, there are risks to consider. Regulation isn't free. The costs associated with compliance, audits, legal fees, maintaining high-quality liquid reserves are substantial. Some stablecoin issuers might pass these costs on to you, the user, in the form of higher transaction fees or lower yields. There's also the risk that some innovative or smaller projects might get pushed out of the market. Overly strict regulation could stifle competition, leaving us with only a few large, dominant stablecoin issuers. This could lead to centralization, which goes against one of the core principles of crypto. The act will likely weed out the weak or shady projects, which is good, but it might also trim away some promising upstarts in the process. So with all this change on the horizon, what can you do right now to prepare and protect your assets? You don't have to just sit back and watch it happen. You can be proactive. First, research. Seriously, dig into the stablecoins you use. Go to their websites and look for a transparency or reserves report. Are they backed by cash and T-bills or something else? Are they audited by a reputable firm? If you can't find this information easily, that's a red flag. Second, stay informed. The regulatory landscape is moving fast. Follow reputable crypto news sources and keep an eye out for updates on the Genius Act's implementation and ratification. Knowing which stablecoins are on the path to compliance will be critical. Third, diversify your stablecoin holdings. This is a classic investment rule that applies perfectly here. Don't put all of your funds into a single stablecoin, no matter how safe it seems. Spreading your holdings across 2 or 3 different well-regarded stablecoins can mitigate your risk if one of them runs into trouble. And finally, be mindful of where you hold and trade your crypto. Use wallets and exchanges that are known for their commitment to compliance and transparency. These platforms are more likely to support regulated stablecoins and delist those that don't meet the new standards, which adds another layer of protection for you. In closing, the Genius Act is a powerful signal that crypto is maturing. It's moving beyond the hype phase and into an era of integration with the global financial system. Regulation is catching up, and that's a double-edged sword. It brings both safety and new challenges. How you choose and use stablecoins in 2025 and beyond will matter more than ever, both for the safety of your portfolio and for your potential profit. This is a huge topic, and I want to know what you think. With these new rules, are stablecoins still a safe bet in your portfolio? Let me know your thoughts in the comments below. If you found this video helpful and want to stay ahead of the curve in this evolving crypto legal landscape, do me a favor and hit that like button, subscribe to Mita Money, and ring the notification bell so you never miss an update. Thanks for watching, and I'll see you in the next video.